Welcome to Market Monday from the investment team in the trust department at the First National Bank. How about that S&P 500? As we come into the final stretch of 2023, the market has gone on a pretty strong rally. And this is notable because it comes in the face of some rather bad news items, which have been just shrugged off as the market marches higher. And when we get good news, the market's been going up even stronger. And when that happens, that's a sign of healthy internals in the equity markets. So we look at this and see the market trading into a range, and we're expecting higher equity market prices as a result of this. And what's going on here? I mean, we've seen some negative data come out on the economy. There's a slowdown that's definitely evident. The Fed has paused its rate hiking cycle. They're calling for rate cuts in 2023, which arguably we're not so sure are going to happen of the scale that the pundits are talking about. We'll get into that a little bit later. But the point being is, when you see strength like this in the market, it shrugs off bad news and continues to go up, and it goes up even stronger on good news. That's a sign that the market is very strong. And we have another sign of strength in the market, in that volatility expectations are very low. So, this VIX reading of 12.5 indicates moves of under 1% are the expectation for the foreseeable future, and it's been that way ever since the end of October. And that's a positive thing. The lower volatility environment definitely shows more confidence in market pricing. But let's talk about this idea that's being bandied about the so-called soft landing. And what we have here is a chart of the leading economic indicators that tend to forecast recession. And it is 10 different indicators that are indexed into one number. And, taken together is used for predictive power. Are we going to enter a recession? And at no point in the history that's captured here in Bloomberg, which goes back to 1959, has this been so low, this indicator, as where we're at, without us entering a recession. That's data point number one. So the odds don't look good from where the leading economic indicators are. Another one is the fact that the Fed has only actually ever managed to engineer one confirmed soft landing among dozens of rate hiking cycles. So when you have those kind of odds, it's probably unlikely that we're going to see that soft landing. And in fact, we're calling for a recession in 2024. And the interest rate futures market is also potentially calling for that, because the interest rate futures market is indicating that we're going to see 3 rate cuts, or rate cuts amounting to 75 basis points in calendar year 2024, which would be consistent with the need to cause the economy to accelerate a little bit to ward off a deeper recession on the part of the Federal Reserve. So all of the data is coming together and indicating, are we going to see a recession? But what does that mean? We're thinking in terms, because we've seen these catastrophic events, 2008, the financial crisis, 2020, the sovereign debt crisis over in Europe in the early 10s. These are major events that were potentially breaking the economies that were involved. So when you look to events like that and you equate that with recession, the idea becomes very fraught with fear. And actually, recession, or expansion of the economy and a contraction, which is what recession means, those are normal parts of the economic growth cycle as we continue to evolve in our economy. So, we see a period of outsized growth, and then we see a pause, and it contracts a little bit, and then it goes again. It's kind of like taking a breath in, taking a breath out. And that recession tends to clear away inefficient and poor investments and allows for the economy to put a foundation up for the next leg higher. So we're not really too worried about it. We have unemployment sitting at 3.7%, and the natural long-term rate of unemployment is considered to be 5%. If we get back from 3.7 somewhere closer to 5, that actually argues that the economy is going to come from an unsustainable position to a more sustainable one over the longer term, and it will be healthy. And there are not signs that the labor market is under extreme stress, and it's unlikely that we're going to see extreme stress in the labor market in this recession, which is looking like it's just a release of the safety valve to set the tone for the next leg higher. So are we going to see one? We're going to go ahead and say probably, but is it going to be terrible? We're also going to say probably not. We do see things resetting into a more sustainable fashion. And let's talk about yields. The interest rate market for corporate bonds has come down dramatically over the last month in light of recent data points. In other words, the 5-year paper is now down 60 basis points in yield. And basically across the board, we're down on the longer end of the curve about 60 basis points. So what that shows us is risk in the market is considered to be lower because corporate bonds include credit risk. In other words, the risk that a corporation will default. That also is driven by a fall in treasury yields, which is commensurate with the idea that inflation is going to abate somewhat, at least in the nearer term, due to these economic reports that have coming out. It's still a great time to be a fixed income investor, though. Yields of 4.5% and higher are pretty excellent comparatively over the last 20 years and allow for income investors to do pretty well. So we're happy to see that environment. That kind of rounds out all of the market information we wanted to talk about this week. And as for data, there are a few important points over the next couple of weeks, but really it's a slow end of the year. And this is good because data points like these, if they come in, and we do have a couple of strong ones, Wall Street tends to go on vacation at the end of the year, and there are less people at their trading desks. There's less liquidity in the market, and surprises in these numbers could cause exaggerated moves. It's not going to necessarily mean anything if we see a big move up or a big move down over the next couple of weeks based on a number that comes out. But there shouldn't be too many of those. In fact, later today we're going to get housing starts. We're going to get tomorrow existing home sales and consumer confidence. That's probably the big one. What the consumer is thinking about the future is generally indicative of what's going to happen with the demand situation going forward. So we're eager to see that. That's expected to show growth from the last period, which would be consistent with a strong consumer and potentially, continued strong levels of demand. We get later in the week GDP and the annualized quarter-on-quarter GDP, which is expected to come in flat at 5.2%. We get the PCE price index. We get the leading indicators index, which is expected to show a little bit of a improvement in its decline from the last period. We get information about income and spending, and then we get the core deflator, which is an indicator that the Fed uses when it's looking at inflation. And that should be interesting, even though, as you can see from over here, Bloomberg doesn't assign a terribly large importance to that. We're thinking in the current environment it does carry that. So rounding things out, we'll get information on durable goods, which is demand, and more sentiment information and information about the labor market. And that basically ends the year in terms of economic data. It should be slow. We're expecting this market, again, which has been grinding higher, it's showing no signs of stopping. And, historically on a calendar basis, the end of the year carries what's called the Santa Claus effect, which is what we seem to be seeing, which is a rally into the year end in the first couple of weeks of January. And that appears to be what's going on right now, and we don't see any reason to alter that. But even with all that said, the recent market activity, the tremendous decline in 2020, followed by an enormous rally, followed by a bear market, and now we're starting to, move into a more upward phase of market growth. We're not going to let that color our investment plans, which are made over the long term. Do this every time, we'll do it again. This is more of a timeline that we're looking for. So we're not going to change our long-term, well-thought-out plan based on what we think is happening in the short term over the next couple of months, quarters, or years. In fact, we're in it for the long haul. So if you have questions about the markets, if you have questions about your accounts, please give us a call. We'd be delighted to talk with you. Hope you have a very happy holiday season. Thanks, and have a great day.